Welcome back to the channel, where we track the pulse of global currency movements and their far-reaching consequences. Today we turn our attention not to the Iraqi dinar, which is our usual focus, but to a significant and rather unexpected development unfolding in the heart of Southeast Asia, a notable shift concerning the Vietnamese dong. This event, which might initially appear to be a localized technical adjustment, holds a deeper narrative and has the potential to subtly reshape the landscape for a variety of emerging market currencies around the world. This unexpected currency movement in Vietnam is far more than a simple fluctuation. It represents a subtle yet profound policy signal that many seasoned market observers initially overlooked. We are talking about a powerful ripple that could spread across Asian economies, influence global trade logistics, prompt portfolio reallocations by international investors, and ultimately affect the general environment in which currencies like the Iraqi dinar operate. Therefore, understanding the mechanism and the motivation behind the dong's recent performance is crucial for anyone monitoring exchange rates, emerging market equity flows, or broader global macroeconomic trends. The core event revolves around the State Bank of Vietnam, SBV, and a key update to its official exchange rate management framework that was put in place just over the past week. While the official communication was understated, presenting the change as a modest, technical step, the foreign exchange markets immediately interpreted its true significance. The result was a palpable strengthening of the dong, a rate of appreciation not seen for some time, which instantly grabbed the attention of currency desks in major financial hubs from Singapore and Tokyo to London. This seemingly minor change quickly transformed into a major signal of intent. Although the State Bank of Vietnam does not always offer complete transparency on its daily operations, the available data and market reactions strongly suggest two critical actions. First, the bank widened the permissible trading band for the dong. And second, it signaled a clear willingness to tolerate, and perhaps even encourage, a stronger currency valuation. Analysts are interpreting this as a decisive step by Vietnam away from a tightly controlled currency regime toward one that allows for greater market discovery of the dong's true worth. Such a policy pivot is highly significant, especially coming from an economy with Vietnam's growing stature in global trade. When a nation that is heavily invested in exports decides to let its currency appreciate, it projects a powerful image of economic confidence to the global stage. It suggests strong economic fundamentals, ample foreign exchange reserves, and a belief in the country's sustainable competitive advantages that go beyond merely offering cheap goods. This self-assuredness is the real story the market is reacting to, not just a numerical change in the exchange rate. Vietnam has truly evolved over the past decade. It has transitioned from being a peripheral player to one of Asia's most dynamic and fastest-growing manufacturing centers. Global giants in electronics, mobile technology, and apparel have increasingly relocated their production facilities to Vietnam, attracted by a skilled workforce, political stability, and an advantageous network of international trade agreements. This influx of foreign direct investment, combined with surging exports, has led to significant trade surpluses in numerous sectors and a consistent record of high single-digit GDP growth in recent years. The decision by the SBV to permit the dong to strengthen is, therefore, a deliberate policy statement rooted in this economic success. The message is simple and profound. Our economy has matured, and our exports are robust enough to withstand a stronger currency. The Vietnamese government is signaling that it no longer perceives the need to maintain an artificially weak currency as a primary tool to boost export volumes. This fundamental shift in economic philosophy from a cheap currency model to a strong economy model is what is causing a stir in global financial circles for international investors. This signal is particularly potent and could trigger strategic portfolio reallocations. A country that demonstrates confidence in its currency regime and permits a more market-reflective valuation becomes a more attractive and stable destination for a foreign capital. Investors who believe Vietnam is beginning a new, more mature phase of its currency policy will naturally be inclined to increase their exposure to Vietnamese assets, including its equity and bond markets. To fully grasp the magnitude of this recent event, it helps to understand Vietnam's historical exchange rate management. For years, the country has operated what is termed a managed float system. Under this structure, the State Bank of Vietnam sets a daily or periodic central reference rate and permits commercial banks a defined band of variation around that rate. This mechanism allows for a degree of flexibility while simultaneously providing the government with the ability to intervene in the foreign exchange market to prevent excessive volatility. In essence, the system is designed to provide stability without the rigidity of a hard peg. Historically, the SBV would adjust this band, intervene with its reserves, and manage the trade-offs between export competitiveness, inflation, and foreign exchange stability. The recent decisive action, however, appears to be an intentional widening of the band that dramatically increases the potential for the dong's appreciation, marking it as a deliberate policy shift, rather than a routine operational adjustment. The hidden trigger behind this pivotal move is likely a convergence of several strategic factors that have aligned at this specific point in time. Firstly, Vietnam's domestic economic fundamentals are exceptionally strong, evidenced by booming exports, continuous manufacturing expansion, and sustained foreign investment inflows. The country's economy is running on high octane. Secondly, the global economic landscape has been shifting, with a significant part of the global manufacturing supply chain gradually diversifying away from China. Vietnam has emerged as a major and direct beneficiary of this global reorganization, solidifying its role as a key player in the Asia-Pacific manufacturing sector. This sustained capital inflow gives the central bank greater latitude in its currency policy. A third factor is the country's long-term commitment to modernizing its financial sector. Vietnam has been actively collaborating with international financial institutions, such as the International Monetary Fund, IMF, and the World Bank, on various reforms including upgrading its banking sector, modernizing its payment systems, and liberalizing its capital markets. The policy logic is straightforward. As the economy becomes more mature and more globally integrated, the currency itself must be granted a greater degree of market-driven freedom. Finally, the timing appears to be highly strategic. With global interest rates and trade flow dynamics currently in a state of flux, Vietnam's policymakers may have astutely judged that the present moment offers the most opportune window to introduce greater flexibility into the currency band. When these four elements are combined, the implicit message is not merely about a technical tweak, but an announcement that the country is confidently initiating a new, more mature phase of its currency and economic policy. This shift in regime, rather than a mere change in the rate, is the real hidden trigger. The market response confirms the profound nature of this policy change. Currency traders immediately adjusted their positions based on the unexpected strengthening of the dong. Export-import businesses have had to rapidly recalibrate their contracts and pricing strategies. Furthermore, officials in several Asian financial centers have reportedly convened to discuss the potential for broader regional currency alignment. This is because a significant currency policy shift by a major manufacturing export powerhouse like Vietnam has tangible effects on trade competition, neighboring economies, and the overall trajectory of investor sentiment. The initial ripple effects have already been visible across other Asian currencies. While not massive, these movements are noticeable. Export-oriented neighbors of Vietnam may feel a growing pressure to adjust their own currency settings to maintain their competitive edge. Investors, in turn, may rethink their existing currency allocations across the region. This is the domino effect in action. When one emerging market currency makes a substantial move, it often compels others in the region to reevaluate their own strategies to remain economically competitive. The story therefore transcends Vietnam and speaks to the core dynamics of Asia's export engine and its regional currency stability. The strengthening of the dong is fundamentally altering the long-held perception of Vietnam's currency. For many years, the dong was widely viewed as a weak, low-value unit primarily used for domestic transactions, with limited significance in global financial centers. This new policy move is beginning to change that narrative. Public commentary and initial reports suggest a shift in the US dollar-dong exchange rate toward key psychological levels, with analysts noting that the SBV's increased band and reference rate mechanism will allow the dong's true market-based value to emerge as opposed to a rate that had been potentially suppressed for years. This brings up a natural question. Since Vietnam is a major export nation, wouldn't a stronger currency ultimately harm its export competitiveness? This is a valid classic economic concern, and the short answer is yes. A stronger currency generally makes a country's exports more expensive for foreign buyers. However, this is where Vietnam's strategic nuance comes into play. The government's actions suggest a strong belief that Vietnam's competitive advantage is no longer solely based on offering the cheapest currency. Instead, Vietnam's new competitive edge is increasingly rooted in high-value-added manufacturing, rising productivity, strategic access through various trade deals, and deep integration into global supply chains. The policy appears to be a calculated decision. Allow the currency to appreciate modestly to reflect genuine economic strength, moving away from an artificially weak currency that invites the risk of inflation, capital flight, and the perception of economic fragility. The long-term strategy is a clear transition from a cheap currency export model to a resilient, strong economy export model. While certain export sectors might experience a temporary or slight compression of their margins in the short term, the anticipated medium-term benefits are substantial. These include an elevated global economic standing, a measurable increase in foreign investor confidence, and a path toward more sustainable and less volatile economic growth. For Vietnam's long-term strategic goals, this shift to a stronger currency, acting as a genuine signal of economic maturity, is likely deemed the more important and sustainable path forward. For those viewers who closely follow the dynamics of the Iraqi dinar and other emerging market currencies, the Vietnam case provides a crucial benchmark. When a major emerging market economy, particularly one with Vietnam's manufacturing might, deliberately shifts its currency regime toward greater flexibility and strength, it sets a new standard for the region and beyond. This action may pressure other export-oriented emerging markets in Asia and potentially other regions to scrutinize and possibly adjust their own currency settings, leading to greater potential volatility, reserve reevaluations, and capital flow shifts globally. Though the Iraqi dinar (IQD) is geographically distant from Southeast Asia, it exists within the same global ecosystem of investor capital and risk appetite for emerging markets. If Vietnam, with its newly affirmed currency strength, successfully attracts a greater share of global foreign capital and manufacturing investment, this capital may, by definition, be redirected away from other emerging markets that are perceived as less stable or less committed to modernization. The link is therefore systemic and indirect, not a direct cause and effect relationship, but a powerful force that shapes the overall context of emerging market investment. To monitor whether this is a fleeting event or the start of a profound regime shift, several key indicators should be closely watched in the weeks and months to come. Firstly, official pronouncements from the State Bank of Vietnam should be tracked for any further indications of wider trading bans or future financial reforms. Secondly, movements in Vietnam's foreign reserve data will be telling. An increase in reserves would signal the central bank's capacity and commitment to supporting a stronger currency. Thirdly, key trade data releases must be scrutinized, particularly to see if Vietnam's export growth can sustain its momentum despite the strengthening dong, which would strongly reinforce the new policy narrative. Fourth, any significant coordinated movements among neighboring Asian currencies would suggest that the ripple effect is transforming into a broader regional adjustment. Fifth, a surge in foreign capital allocations into Vietnam's equity and bond markets would be the strongest confirmation of global investor confidence in the country's new currency direction. The policy context surrounding this currency move makes the timing even more insightful. The ongoing global reorganization of supply chains, The diversification of manufacturing and the renegotiation of international trade agreements position Vietnam uniquely. The country has meticulously built up its infrastructure, signed extensive free trade agreements with major economic blocs like the US, Japan, and the EU, and been systematically modernizing its financial systems. The strengthening of the dong is thus not an isolated event but a visible consequence of this long-term, calculated plan. This strategic move may also be connected to broader financial reforms within Vietnam, including the modernization of its digital payment infrastructure and the progressive liberalization of its capital markets, all of which enhance the dong's international credibility and usability. Research suggests that the country has been working diligently to upgrade its entire monetary policy framework and banking sector to align its currency policy with the reality of a modern, globally integrated economy. The dong's appreciation is a confident display of this successful internal transformation. While the strategic implications of the stronger dong are largely positive, it is essential to acknowledge the inherent risks involved in such a shift. Allowing for greater currency strength immediately places pressure on exporters who have built their business models on the assumption of a weak dong and competitive pricing. This may slow growth in certain sectors if they fail to sufficiently upgrade their productivity to offset the increased cost base. Furthermore, Vietnam remains exposed to global economic headwinds. The continued strength of the US dollar, persistent supply chain pressures, and various geopolitical shocks present continuous challenges. Navigating the delicate balance of maintaining export volume while allowing the currency to appreciate is a complex undertaking for the State Bank of Vietnam. Capital flows in emerging markets can also reverse abruptly if global risk sentiment changes, which could quickly put downward pressure on the dong. Inflation also remains a key concern. While a stronger currency can effectively help to mitigate imported inflation by making foreign goods cheaper, internal cost pressures from rising wages and expanding credit could still accelerate domestic price increases. Analysts have pointed out that the new policy mix and exchange rate management strategy carry a degree of uncertainty, requiring continuous, flexible policy responses from the central bank to manage these various complex trade-offs. For international investors evaluating currency markets, funds, or debt in emerging Asia, Vietnam may well become an increasingly compelling destination. A currency that demonstrates a trend of strengthening tends to enhance overall investor confidence, reduce the perceived currency risk premium, and encourage long-term foreign direct investment, not just speculative capital. As the Vietnamese dong potentially becomes more prevalent in regional payment systems and global trade settlements, new avenues for portfolio exposure will emerge, potentially positioning Vietnam as a relative outperformer in the region. Conversely, this positive development for Vietnam may inadvertently highlight and amplify structural weaknesses in other countries with less clear or less credible currency frameworks. The inevitable comparison to Vietnam's modernizing shift will intensify the scrutiny on other emerging market currencies, potentially driving risk aversion in those with perceived fragility. For currency traders, this policy change creates the potential for both increased volatility and new trading opportunities rooted in the emerging economic strength of Vietnam. The fundamental lesson from this event for all emerging market currency followers, including those watching the Iraqi dinar, is the paramount importance of regime change. The long-term direction and maturity of a country's policy framework and economic strategy matter far more than any single-day rate movement. It is the credibility of the policy shift that anchors investor confidence, a principle that applies across the board to every developing economy. Looking at manufacturing and trade flows, the stronger dong implies a higher cost base for Vietnamese exports in US dollar terms. This will place continuous pressure on manufacturing margins unless productivity rates are consistently upgraded. However, this may be precisely the core of Vietnam's confidence. A deliberate move toward higher value manufacturing, increased use of automation, and stronger partnerships with global brands. The currency's move is, in this light, a declaration of economic maturity, signaling a move beyond reliance on cheap labor to a foundation of global competitiveness. For other countries competing with Vietnam in the manufacturing sector, such as neighboring Southeast Asian and certain South Asian nations, this development serves as a wake-up call. If Vietnam can successfully command a higher cost base while maintaining robust export growth, the entire regional competitive dynamic is fundamentally reshaped. This could lead to shifts in supply chain decisions, where companies may choose Vietnam not as the absolute lowest cost base, but as the most stable, logistically efficient, and currency-credible option. The broader regional implications are significant. When Vietnam signals a stronger currency, its export-heavy neighbors whose currencies might be comparatively weakening will face increased competitive pressure. They may be compelled to respond by either adjusting their own currency policies, implementing major domestic productivity enhancements, or significantly altering their economic strategies. Analysts suggest this could potentially initiate an Asian currency reset, a period where regional currencies realign to accurately reflect the new realities of trade and manufacturing. This regional realignment forces global investors to conduct a rigorous reassessment of currency risk across the entire region. It also necessitates that governments in neighboring countries be prepared to formulate clear, coherent responses to maintain their own economic equilibrium. For dedicated currency watchers, including those following the Iraqi dinar, the focus must now expand beyond single country analysis to include a thorough understanding of these rapidly evolving regional dynamics and interconnected capital flows. So, why does the Dinar Daily Channel focus on Vietnam? Because, as we've established, the world of currency is fundamentally interconnected, despite the vast geographic distance from Iraq. International investors continuously assess and allocate emerging market risk. If Vietnam solidifies its position as a highly attractive, increasingly stable destination with a stronger currency, capital that might otherwise have been channeled toward less known or less stable markets could inevitably be diverted. If the regional currency environment in Asia shifts towards greater stability and measured appreciation, it inherently raises the global benchmark for currency risk management. This systemic change subtly pressures markets to reevaluate countries like Iraq in the context of these newly strengthened emerging economies. While this development does not create a direct, immediate policy impact on the Iraqi dinar, it fundamentally alters the global environment in which all currency policy decisions, including those regarding the dinar, are made. To truly track the trajectory of this major development, a specific watch list is essential for the coming weeks and months. First, monitor the reference rate announcements from the State Bank of Vietnam. A sustained, upward trend in the daily central rate is a key indicator. Second, watch for any further widening of the exchange band, which would signal a commitment to even greater currency freedom. Third, closely track Vietnam's foreign reserve levels. A sustained increase would confirm policy support for strength. Fourth, pay attention to the flow of global capital into Vietnam. Increased allocations to Vietnamese stocks and bonds confirms robust investor confidence. Fifth, scrutinize Vietnam's export growth trends, specifically looking for sustained strength even with a stronger dong, which validates the new economic model. Sixth, observe neighboring Asian currency movements. A coordinated regional response signals a spreading ripple effect. Finally, listen carefully for any statements from policymakers that explicitly affirm a mindset shift from a cheap currency strategy to a strong economy strategy. This is the most critical, qualitative clue of a lasting regime change. Stepping back, the significance of the dong's move transcends mere numbers and charts. The Vietnamese dong has historically been defined by its perceived undervaluation and tight government control. It was not a global benchmark. This recent action, this notable jump, this regime change is a powerful, unmistakable message. Vietnam is ready to assert its economic strength, and its currency is demanding global respect. This fundamental shift in national narrative is what truly changes the calculus for investors and policymakers worldwide. For decades, The standard playbook for emerging markets relied on a weak currency to drive growth through cheaper exports. However, that model comes with significant liabilities, including the risk of chronic inflation, vulnerability to sudden capital flight, and a general perception of economic fragility. Vietnam's clear move away from this model suggests an evolution in the framework for success among export-driven economies. This evolution carries substantial consequences for global trade and currency markets everywhere. In summary, the true engine behind the Vietnamese dong's surprising movement is not just a technical change in the central bank's operations, but a deliberate and strategic policy shift. The State Bank of Vietnam's willingness to widen its trading band and allow the currency to move toward a market-determined value signifies a decisive national repositioning. The immediate consequences include a surge in investor confidence, increased competitive pressure for other exporters, a potential realignment of regional currencies, and shifts in global capital flows that will impact the entire emerging market ecosystem. The Iraqi dinar, while indirectly involved, exists within this increasingly interconnected global framework, making this development a must-watch for any currency observer. The dong's journey as a globally respected currency is far from over. In many ways, it has only just begun. We will continue to track these announcements, reserve data, trade figures, and capital flows as we follow the broader, ever-evolving global currency story.